What if I told you that your credit card balance could stay exactly the same, but your credit utilization could drop dramatically? And no, I'm not talking about paying off your entire credit card bill. There's a simple strategy that many people overlook: increasing your available credit without increasing your debt. Used correctly, this can make your credit utilization ratio look much healthier. But there's an important catch. A higher credit limit is not free money, and asking for a credit limit increase can sometimes affect your credit profile, depending on the bank, country, and how the request is handled. So in this video, I'll explain exactly how credit utilization works, how the credit limit strategy works, what you can do to lower utilization quickly, and, most importantly, what mistakes you should avoid. Let's break it down. 1. What is credit utilization? First, let's understand the basic idea. Your credit utilization ratio is the percentage of your available revolving credit that you are currently using. Here's a simple example. Imagine you have a credit card with a limit of $5,000 and your current balance is $2,000. Your utilization is $2,000 divided by 5,000 equals 40%. So your credit utilization is 40%. Now imagine the bank increases your credit limit from $5,000 to $10,000. You still owe exactly the same $2,000. But now, $2,000 divided by 10,000 equals 20%. Your debt didn't change, your spending didn't change, but your utilization dropped from 40% to 20%. That's the basic idea behind the credit limit increase strategy. 2. Why does credit utilization matter? Credit utilization can be an important factor in credit scoring models. Generally speaking, lower revolving credit utilization is viewed more favorably than high utilization. Think about it from a lender's perspective. Someone with a $10,000 credit limit who consistently carries a $9,000 balance is using most of their available credit. That's very different from someone with the same $10,000 limit who typically uses $1,000. So Utilization Hub gives lenders and scoring models information about how heavily you're relying on revolving credit. But here's something important. There is no universal magic percentage that guarantees a particular credit score. You'll often hear people say, "Bono, keep utilization below 30%. That's a useful rule of thumb, but it's not a guarantee. For some scoring situations, lower utilization can be better, and your overall credit profile matters much more than one single number. 3. The credit limit increase strategy. Now let's get to the main strategy. Suppose you have 3 credit cards. Card 1 has a limit of $3,000. Card 2 has a limit of $4,000. Card 3 has a limit of $3,000. Your total available credit is therefore over $10,000. Now imagine your combined balances are $4,000. Your overall utilization is the $4,000 divided by 10,000, 40%. That's relatively high. Now suppose your card issuer approves a credit limit increase on one of your cards. Your total available credit increases from 10,000 to 15,000. Your balance remains 4,000. Your new utilization becomes $4,000 divided by 15,000, which is about 26.7%. You didn't pay off one lot of debt, but your utilization dropped significantly. That's why a legitimate credit limit increase can be useful. 4. But here's the part. Most people miss a credit limit increase is only helpful if you don't use the extra credit to create more debt. This is where people get into trouble. Imagine your limit increases from 5,000 to 10,000. You feel like you suddenly have another 5,000 available. So you start spending more. A few months later, your balance is 8,000. Your utilization is now 80%. So the credit limit increase didn't solve your problem. It simply gave you more room to borrow. That's why you should think about a higher credit limit as a risk management tool, not as extra spending power. 5. How to request a credit limit increase. So how do you actually get one? Start with your existing card issuer. Many banks allow customers to request a credit limit increase through their online banking app or website. Some may also allow you to request it over the phone. The exact process varies by issuer and country. Before requesting the increase, make sure your account is in good standing. That usually means your payments are being made on time. Your account isn't seriously delinquent. Your income information is accurate and up to date. And you're not applying for multiple new credit accounts at the same time. If the bank asks for your income, employment, or housing information, provide accurate information. Never inflate your income just to get a larger credit limit. 6. The most important question. Will a credit limit increase hurt your credit score? This is where you need to be careful. A credit limit increase request can be handled differently by different lenders. Some issuers may evaluate the request using information they already have. Others may perform a credit inquiry, and the impact of that inquiry can vary depending on the credit reporting system and scoring model being used. So before you submit the request, check whether the issuer says the request involves a hard credit inquiry. If the bank confirms that it's only a soft inquiry or no additional inquiry, that's generally less concerning from an inquiry perspective. But don't assume. Check the terms first. 7. The faster alternative. Pay before the statement is reported. Now here's another strategy that's often much more useful. You don't necessarily have to wait for your credit card payment due date to reduce the reported balance. Many credit card issuers report balances to credit bureaus based on information around the statement cycle. That means the balance appearing on your credit report may not be the same as the balance you see on your account today. For example, imagine your card has a 5,000 limit. You've spent 3,000. Your utilization is potentially around 60%. But your payment due date is still 2 weeks away. If you make a payment before the relevant statement balance is generated or reported, your reported balance may be lower. For example, you could pay 2,000. Now only 1,000 remains. If that $1,000 balance is what gets reported against the $5,000 limit, the reported utilization would be around 20%. This is sometimes called paying before the statement date or early payment. But remember, the exact reporting date varies by issuer. So don't assume your payment will instantly change the balance reported to the credit bureaus. 8. Statement date versus due date. This distinction is extremely important. Your due date is the date by which you need to make the required payment to avoid being late. Your statement date is when the billing cycle closes and the statement is generated. These are not necessarily the same date. If your goal is simply to avoid late payments, focus on the due date. But if your goal is to manage the balance that may be reported to credit bureaus, you also need to understand your statement cycle and the issuer's reporting practices. So check your card agreement or contact your issuer. Don't blindly copy someone else's statement date hack. Your card may work differently. 9. The best combination strategy. Now let's combine everything. Suppose your credit card limit is 10,000. Your balance is 6,000. That's potentially 60% utilization. You could use two strategies. First, pay down the balance before the relevant reporting point. For example, if you reduce the balance to $2,000, utilization becomes 20%. Second, if you're eligible, request a credit limit increase. Suppose the bank increases your limit to $15,000. Now, the same $2,000 balance represents only about 13.3% utilization. That's a much stronger position. But remember, the real solution is reducing debt. The credit limit increase is simply changing the denominator. You're increasing available credit. You're not eliminating what you owe. 10. Don't apply for multiple credit cards just to reduce utilization. Here's another common mistake. Someone sees their utilization is high and thinks, oh, I'll just open 5 new credit cards. That could increase total available credit. But it also creates new accounts, new applications, and potentially multiple credit inquiries. It can also make your financial situation more complicated. And if you start spending on those new cards, your total debt can increase. So don't confuse more credit with better financial health. If you already have enough cards, managing the balances on your existing accounts may be the smarter approach. 11. Don't close old credit cards immediately. Here's another mistake people make. They pay off a card and immediately close it. Depending on your credit profile and scoring system, closing a revolving account can reduce your total available credit. That can increase your overall utilization if you still have balances elsewhere. For example, you have 3 cards with a combined limit of $15,000. You owe $3,000. That's 20% utilization. Now you close a card with a $5,000 limit. Your available credit falls to $10,000. Your $3,000 balance now represents 30% utilization. Your debt didn't increase, but your utilization did. That doesn't mean you should never close a card. There can be good reasons to close an account. Just understand the possible consequences before doing it. 12. Don't max out the card after getting the increase. This sounds obvious, but it's one of the biggest traps. Let's say your bank gives you a $5,000 increase. You now have an additional $5,000 of available credit. Don't think, great, I can spend another $5,000. Instead, think, great, I have more financial breathing room, but my spending limit stays the same. That's the mindset you want. The goal is to make your credit profile more resilient. not to increase your lifestyle expenses. 13. What if the bank says no? Don't panic. A rejected credit limit increase doesn't mean your credit is permanently damaged. The bank may simply decide that your current income, payment history, existing balances, or overall risk profile doesn't justify a higher limit. In that situation, focus on the fundamentals. Pay every bill on time. Reduce revolving balances. Avoid unnecessary applications for new credit. Keep your credit reports accurate and give your financial profile time to improve. Sometimes the best credit hack isn't a hack at all. It's consistency. 14. The 3-step utilization plan. If you want a simple strategy, remember these 3 steps. Step 1. Know your numbers, calculate your total credit limits and total revolving balances. Don't guess. Write them down. For example, total credit limits, 20,000. Total balances, 8,000. Utilization, 40%. Now you know exactly where you stand. Step 2. Reduce the reported balance. If possible, make payments before the relevant statement or reporting date, but continue making at least the required payment by the official due date. Never sacrifice on-time payment just to optimize utilization. Step 3. Request a higher limit. Carefully. If your account is in good standing and the issuer offers a credit limit increase request, check the terms first. Find out whether a credit inquiry may occur. If the increase is approved, don't increase your spending. Let the additional available credit work in your favor. 15. Here's the real hack. And honestly, this is the most important part of the entire video. The real hack isn't getting a bigger credit limit. The real hack is understanding how credit utilization is calculated and when your balance is reported. Once you understand those 2 things, you can make smarter decisions. A person with a 10,000 limit and a 2,000 balance has 20% utilization. A person with a 20,000 limit and a 2,000 balance has 10% utilization. But both people still owe the same 2,000. So if you qualify for a legitimate credit limit increase, it can improve the ratio. But if you need the higher limit because you're struggling to pay your existing debt, that's a warning sign. In that situation, increasing your credit limit may actually make the problem worse. 16. One more important warning. Never pay a company just because they promise to instantly boost your credit score. Be especially cautious if someone tells you, pay us and we'll increase your credit limit. Or, use this secret trick and your credit score will jump overnight. There is no universal magic formula that guarantees a particular credit score increase. Credit scoring is complex. Different countries use different credit systems. Different lenders report information differently. And different scoring models can evaluate the same information differently. So focus on strategies you can actually control. Pay on time. Keep balances manageable. Avoid unnecessary debt. Check your credit reports for errors. And use credit responsibly. 17. Final example. Let's finish with one simple example. Imagine you have a credit limit. $10,000 balance. $6,000. Your utilization is 60%. You make a $4,000 payment. Your balance falls to $2,000. Now utilization is at 20%. Then your bank approves a credit limit increase from $10,000 to $15,000. Your $2,000 balance is now only 13.3% of your available credit. Notice what happened. The biggest improvement came from paying down the balance. The credit limit increase simply made the ratio even lower. That's the correct way to think about this strategy. So can increasing your credit limit lower your credit utilization instantly? Yes, mathematically, it can lower your utilization as soon as the higher limit is reflected in the relevant credit data. But that doesn't mean your credit score will instantly increase by a specific number. And it definitely doesn't mean you should spend more. The smartest strategy is simple. Increase available credit only when it makes financial sense. Reduce your outstanding balances. Understand your statement and reporting cycle. And never use a higher limit as an excuse to take on more debt. If you found this video useful, hit the like button and subscribe to BNR Universe for more practical videos about money, credit, finance, technology, and the strategies that can help you make smarter financial decisions. And remember, more credit is not more money. It's simply more available borrowing capacity. Use it wisely. Thanks for watching, and I'll see you in the next video.